Do you ever just look at the market, see a massive shift in central bank policy, or maybe watch some major geopolitical event unfold and wonder why the price doesn't just move in a straight line?
Oh, yeah. I mean, it is arguably the most common and honestly the most expensive frustration in the entire financial world.
Right, because you look at it and you think, well, it should just be simple cause and effect.
Exactly.
Like a central bank aggressively cuts interest rates, so capital flows should immediately adjust to that new reality, and the chart should just, go straight up or straight down.
Yeah, that's the logical assumption.
But then you actually watch the screen, and reality is far more complex. It's messy. It it shakes you out of your position right when you thought you had it completely figured out.
We so desperately want the market to be this like clean equation. We want A plus B to equal C.
Totally.
But that expectation completely ignores the actual physical mechanics of how human beings, and especially massive institutions, actually put their money to work over time.
Which is exactly what we're getting into in today's deep dive. We've got a really fascinating stack of research today, institutional trading models, some great market psychology papers, and a few incredible listener notes, too.
Great batch of sources.
Yeah, really good stuff. We are unpacking this concept of the market campaign because, as these sources show, a market move is not a static one-time event.
Right. It's a living, breathing process. It evolves.
Exactly. The exact same fundamental catalyst will produce wildly different price behavior depending on, well, how long it's been happening and how many people are already crowded into the trade.
And understanding this life cycle is absolutely vital for you as a listener. I mean, trying to predict the exact top or the absolute bottom of a market is just a guaranteed way to drain your account.
Oh, 100%.
The actual superpower you can develop is recognizing when the physical behavior of the price stops acting like an early stage trend and starts acting like a trap.
So true. So let's start at the beginning. Every single market campaign starts somewhere. It has this very uncomfortable birth, which is called the initiation phase.
Right, the initiation.
Something big just changed in the macroeconomic landscape. Maybe there's this massive divergence in bond yields between two countries, or a brand new geopolitical reality that just fundamentally shifts how capital needs to be allocated.
The underlying incentives have officially shifted.
Right. But the catch is, hardly anyone is actually participating yet.
Yeah, the defining characteristic of this initiation phase is just extreme uncertainty.
Mm-hmm.
You have a legitimate shift in the fundamental backdrop, but conviction is incredibly uneven across the landscape. Very few participants are actually fully positioned.
So they're just watching.
Exactly. Most are sitting on their hands trying to figure out if this shift is the real deal
Yeah.
or just, temporary noise.
It's kind of like arriving at a massive stadium concert, but like hours before the doors even open.
Oh, that's a good way to put it.
Like, you have the ticket, you read the venue website, you know for an absolute fact the band is playing today.
Right.
But you pull up, and the parking lot is completely desolate. There's not a single car anywhere.
It's just empty asphalt.
Exactly.
Yeah.
So you sit there behind the steering wheel looking at the empty lot, and human nature just kicks in. You start second-guessing the core facts.
You think, wait, did I get the month wrong?
Yes, yes. Is the concert actually tomorrow? Am I at the wrong stadium? That extreme psychological discomfort, that feeling that you must have made a mistake because nobody else is here yet, that is exactly what trading the initiation phase feels like.
It feels awful.
It really does. The trend is entirely under-owned, and it feels highly uncomfortable to actually put real money on the line.
But that feeling of isolation, that is the key to understanding the chart. It actually dictates the physical price action.
How so?
Well, because there aren't enough people on the other side of the trade to absorb the incoming flow. The moves you see on the screen are incredibly impulsive. They are super clean. When the price moves, it just glides.
Mechanically speaking, I assume that's because of the order book, right?
Spot on.
Like, if a few massive macro funds, the guys who look at the big economic picture and take those huge early bets, if they decide this yield divergence is real, they just start buying aggressively.
And because the crowd hasn't arrived yet, there is no massive wall of sellers waiting to take the other side of their trades.
So they just tear right through the prices.
They essentially sweep the order book clean. Their buying pushes the price up quickly and smoothly because there's simply no resistance.
Wow.
And when the market does inevitably pull back, those pullbacks are incredibly shallow. They are just tiny, fleeting little dips.
Because people are eager to get in.
Exactly. The moment the price drops even a fraction, those early adopters step right back in to build up their massive positions.
So it's basically a sprint. It's clean, but it feels awful because you feel completely alone in the trade.
Yeah, it's a very lonely phase.
But that isolation doesn't last forever, obviously. Let's zoom out for a second. As the days or weeks pass, the narrative starts to clear up. That empty parking lot starts filling up with cars.
The early tailgaters arrive.
Right. The macro funds are joined by real money accounts like your massive pension funds and endowments, and all those systematic trend following strategies start piling in. We enter the expansion phase.
Now, this is traditionally the golden age for trend followers. The entire structure of the market fundamentally changes during expansion.
So the vibe shifts completely.
Entirely. The initial incentive that yield divergence or policy shift is still the core driver, but now it is being supercharged by mass participation.
The trade gains total acceptance. It's not a fringe, contrarian idea anymore. Everyone gets it.
And you can see this acceptance so clearly in the price behavior. The chart structure becomes a bit more complex, but it remains highly predictable.
Okay, what does that look like?
Those tiny shallow pullbacks from the initiation phase start getting deeper, but they are orderly. You start seeing classic, really recognizable technical patterns forming.
Like bull flags, right? Where the price shoots up, takes a breather, and just kind of drifts down slowly in a neat little channel, and then shoots up again.
That neat little channel is literally just the market, digesting the new participants smoothly. Momentum feeds on itself during this phase.
Because the chart looks good.
Yes, the performance of the asset starts attracting even more capital.
And a lot of that capital is systematic. I think it's important to clarify for anyone not steeped in institutional trading. When we say systematic, we're talking about pure, emotionless algorithms.
Code. Just math.
Right. These programs aren't reading the morning news. They don't care about the geopolitical catalyst that started the move. They are simply looking at mathematical thresholds on a chart.
Exactly. If a fast-moving average crosses above a slow-moving average, the program automatically executes a buy order.
Which creates a fascinating self-reinforcing loop, doesn't it?
It really does. The systematic funds see the momentum, so their algorithms buy.
And that pushes the price up more.
Right. That massive influx of algorithmic buying creates even more upward momentum, which then triggers the next tier of slower algorithms.
Wow, so it just cascades.
It cascades beautifully. The trend is clearly defined. The narrative is plastered everywhere. And participating in the market actually feels really, really good.
Yeah, here's where it gets interesting. Eventually, we hit a saturation point.
Yes, the dreaded saturation point.
We transition out of that beautiful, orderly expansion phase and into the maturity phase. And according to all the literature, this is where trading accounts go to die if you don't know what you are looking at.
It's an absolute meat grinder.
Because the trade is no longer a secret. It is widely understood. It is discussed on every major financial news network. It is incredibly crowded.
We refer to this as information diffusion. And the ultimate result of information diffusion is the death of asymmetry.
The death of asymmetry. I like that.
Well, think about the very beginning, during your empty parking lot phase. The disagreement and the isolation created an asymmetrical opportunity.
Because nobody was there yet.
Right. You were taking a risk, sure.
Yeah.
But the potential reward was massive because absolutely nobody else was positioned for it yet.
But in the maturity phase, the trade is just full consensus.
Right.
Literally everyone agrees.
And consensus always comes with a heavy cost. When everybody sees the exact same opportunity, the mathematical edge evaporates.
Because it's already priced in.
Exactly. The
Yeah.
narrative is already completely baked into the positioning. The broader market has already absorbed the information, interpreted it, and fully deployed their capital.
Wait, but hold on. I need to challenge this a bit.
Okay, go for it.
Let's say this whole trend started because country A is hiking rates aggressively and country B is dropping them to zero. That creates a massive yield gap.
A huge gap, yeah.
Okay, so 6 months later, we're in the maturity phase, but that gap is still there. In fact, maybe the central banks just held a press conference and reiterated their exact same stances.
Sure.
The fundamental macroeconomic gravity pulling that trade is completely unchanged. So why on earth wouldn't the capital just keep flowing? The engine is still running.
It is the most common trap in the financial world. The catalyst absolutely can persist. It can remain a fundamental, undeniable fact.
Right.
But it stops mattering to the price. It stops moving the needle because it has already been acted upon by the vast majority of the market participants.
Oh, I see.
The market stops being driven by the original incentive, and it becomes strictly flow-driven.
Break down flow-driven for us. What does that actually look like beneath the surface?
It means the market environment is no longer about new money coming in to establish fresh positions. It is entirely about how existing highly crowded positions are being managed.
Okay, that makes sense.
Think about it logically. If 90% of the market is already fully invested and holding a long position, who is left to buy?
Nobody.
Exactly.
Right.
The marginal buyer has simply disappeared. The price becomes incredibly sensitive to profit-taking.
Because any selling has a huge impact.
Right. Even a small wave of selling can cause a massive disproportionate drop because there is no fresh capital waiting in the wings to catch it.
Okay, so how do you actually spot this friction on a chart? If I'm looking at my screen, how do I know we've shifted from that beautiful, orderly expansion into a messy, dangerous maturity phase?
You have to focus on the mechanical changes in the pullbacks and the breakouts.
Let's look at pullbacks first.
Okay. Early on, as we established, pullbacks are shallow gifts. Mid-stage, in expansion, they are deeper but highly orderly. You can buy the dip with confidence.
Great, the bull flag.
But in the late stage, pullbacks become entirely erratic.
So instead of that neat little bull flag where the price calmly pauses, it just, violently drops, shapes everyone out of their positions, and then rockets back up.
It looks exactly like that. They extend way too far. The price blows past obvious support levels. It looks like the sky's completely falling, and then it violently reverses back in the other direction.
Wow.
It traps everyone. The predictability that defined the earlier trend completely disappears. The chart starts to look overlapping, fragmented, and just exhausting.
It essentially becomes noise.
Pure noise.
What about breakouts? Because buying the breakout, like waiting for the price to cross a previous high and jumping in, that's basically the cornerstone of momentum trading.
Buying breakouts in the maturity phase is absolutely toxic. We call this the breakout trap.
The breakout trap?
Yeah. Early in a campaign, a breakout follows through beautifully because there is no overhead resistance. But in maturity, breakouts fail constantly.
Why do they fail?
Well, the price will push past an obvious high, trigger a massive cluster of buy orders, get everyone incredibly excited, and then immediately reverse and plummet.
Oh, let's unpack the mechanics of that, because that's huge.
It happens every day.
So I'm picturing a stock that has been stuck under $50 for weeks. Everyone watching knows 50 is the ceiling.
Right.
So a lot of retail traders place their buy stops right above that line, meaning the second the price hits $50.10, their brokerage account automatically executes a buy order.
They think it's off to the races.
Exactly. But what you're saying is the massive macro funds who bought way down at $30, they actually need all those automatic buy orders to trigger.
They desperately need them. The overall market isn't trying to start a new leg of the trend.
They're trying to get out.
Exactly. The big players who've been holding since the initiation phase are just hunting for liquidity. They have millions of shares to offload.
And they can't just sell them all at once.
No, if they just hit sell in a quiet market, they will completely crash the price and ruin their own profits. They need a massive artificial burst of buying liquidity to sell into.
Wow.
So they use those obvious breakout levels, and the cluster of buy stops sitting there to facilitate their own exit. They aren't pushing the price higher. They are handing off their massive positions to the latecomers.
That is just a phenomenal explanation of a liquidity grab, which naturally brings up another symptom, volatility. Volatility is widely misunderstood. Yeah, because if you flip on any financial channel during a wild market swing, you will inevitably hear some pundit say, oh, volatility's back, it's a trader's market.
Like it's a good thing.
Right. The assumption is that big swings equal big opportunity.
That is a very dangerous misconception.
Yeah.
You must distinguish between early volatility and late-stage volatility.
What's the difference?
Early volatility is directional. It expands aggressively in the direction of the trend. The daily ranges get bigger as the price moves decisively up or down. But late-stage volatility is strictly two-sided.
Meaning the intraday swings are absolutely huge, right? Like the price goes up 2%, down 3%, up again.
Exactly.
But by the end of the week, the market has gone absolutely nowhere.
Exactly right. Volatility in a mature market represents conflict, not conviction. It is buyers and sellers slamming into each other at high speed.
It's just a mess.
It is reactionary. It is no longer a single dominant flow of capital. It is a brutal, directionless tug of war.
But the real story is what is happening inside the heads of the people clicking the buttons.
The psychology is the best part.
The psychological trap here is just fascinating. You have this intense, invisible conflict happening behind the scenes. On one side, you have the latecomers.
Right.
They are buying purely out of FOMO, the fear of missing out. They watch this asset go up for months. They finally read a glowing article about it in the mainstream news, and the trade finally feels completely comfortable to them.
And that comfort is exactly what makes it so incredibly dangerous. They are no longer making a fresh, objective assessment of the macroeconomic incentives.
They're just chasing.
Right. They're simply chasing a chart that has already moved.
And on the exact opposite side of that trade, you have the early adopters.
Yep.
The smart money that parked in that empty stadium lot 6 months ago.
The guys who took the real risk.
Exactly. While the retail crowd is finally feeling comfortable enough to hit buy, those early participants are quietly taking their profits and dramatically reducing their risk. This creates a massive distribution environment.
Distribution is the quiet, systematic transfer of the asset from the strong hands of the early adopters to the weak hands of the latecomers.
It's a handoff.
A very expensive handoff. Even if the overarching trend on the weekly chart hasn't officially broken yet, the internal dynamics have completely flipped.
The energetic buyers are met by massive sellers.
Yes. The enthusiastic buyers are being perfectly matched by the massive sellers. The latecomers are providing the exact liquidity the early adopters need to get out safely.
That makes total sense.
That is why the marginal buyer loses all their power to push the price up. They are buying with everything they have, but the price isn't advancing because a massive fund is happily feeding them all the supply they want.
Which perfectly explains one of the most confusing phenomena you will ever witness in finance, the news paradox.
Oh, this traps so many people.
Let's set the scene for the listener. A company releases an earnings report that just shatters every expectation.
Blows it out of the water.
Right. Revenue is up, debt is down, the forward guidance is spectacular. Or maybe it's a stellar national jobs report. It is objectively, undeniably fantastic news.
The best news possible.
The headline hits the wire and the market immediately falls off a cliff. It just tanks.
It is the ultimate head-scratcher for anyone who treats the market purely as a logical machine of cause and effect.
Why does a great headline cause a massive crash?
Because of every single mechanical shift we just discussed. That pristine, fundamentally bullish news isn't actually new information to the institution.
We already knew.
Exactly. It just publicly confirms what that heavily crowded, mature market already figured out and priced in weeks or even months ago.
So the latecomers see the headline on their phones, they smash the buy button, and the early macro funds essentially say, thank you very much, and hand them the heavy bags.
That is the exact dynamic. Good news in a mature campaign is very often the specific trigger for a sharp, painful reversal.
Because the liquid...
Right. The latecomers rushing in on the headline create a beautiful, deep pool of exit liquidity. The smart money uses the euphoric headline to dump their positions.
Wow.
The news was objectively good, but the positioning was completely saturated. The market transitions abruptly from trading the core incentive to trading the flow of exits.
So what does this all mean for you listening to this deep dive right now? It means you require a radical shift in your daily mindset as a market campaign evolves.
They'd have to adapt.
Because what works beautifully in the early initiation and expansion stages will actively destroy your capital in the late stages.
Yeah.
You cannot blindly buy pullbacks anymore.
No.
You cannot chase those exciting breakouts.
Your entire risk management framework has to adapt to the friction. If you are looking to enter a market that is already a dominant headline on financial networks, your toolkit needs to change immediately.
What does the new toolkit look like?
First, dramatically reduce your position sizes. Second, take profits proactively. Do not hold out for the massive structural home run because the clean, easy trends are long gone.
Right.
Stop assuming the chart will just continue up and to the right forever.
You essentially have to start looking for opportunities in the extremes, right? You look for mispositioning.
Exactly.
Instead of buying the breakout, you start fading those failed breakouts, meaning when the price pokes above the high and starts to stall, you actually bet against it and trade in the opposite direction.
You fade the false move.
You recognize that the internal structure of the market has fundamentally changed. So instead of looking for some holy grail indicator, it really comes down to a process of constant observation.
Observation is everything.
First, you have to identify the fundamental incentive. Is there an actual macroeconomic catalyst driving this?
That's step one.
Second, you must assess the participation level. Are you sitting in the empty parking lot, or is your barber pitching you the trade?
If it's your barber, run.
And finally, you have to completely ignore the public narrative and observe the actual physical price behavior.
Do not trust the narrative. Trust the chart. Is the price action clean and impulsive? Or is it overlapping, choppy, and exhausting?
Right. Look at the mechanics.
Are those obvious breakout levels holding and continuing, or are they failing instantly and trapping late buyers? Those objective observations will tell you exactly where you are in the campaign lifecycle.
And once you know your location, you know exactly which toolkit to deploy.
Precisely.
We started this deep dive by talking about that dangerous expectation of a straight line, that myth of simple, predictable cause and effect. I want to challenge you to drop that expectation completely.
It's time to let it go.
Stop obsessing over predicting the exact top or the exact bottom of the next big macro move.
It is a complete fool's errand. The transition from a massive generational opportunity into a complex, messy, account-draining environment does not happen with a neat little warning headline.
It happens with friction. It happens when the physical behavior of the price quietly changes beneath the surface.
Exactly.
So the next time you are looking at your screen and you feel completely 100% comfortable entering a popular, widely discussed trade, ask yourself the most important question in the market.
The only question that matters.
Are you the smart money initiating the campaign, or are you just providing the exit liquidity for everyone else?